Everyone wants better returns. That is the most natural desire in all of investing. And it is almost without exception the desire that destroys more capital than any market crash, any recession, any fraud, or any black swan event ever could. Not because the desire is wrong, but because of what it makes you do. Today, I want to examine something I have spent the better part of 5 decades watching investors get wrong. Not occasionally, consistently. Across bull markets and bear markets, across generations, across asset classes, and across levels of sophistication. Smart people. People with spreadsheets and Bloomberg terminals and graduate degrees from institutions that charge more per year than most people earn, they fall into the same trap. And the name of that trap is performance chasing. It is subtle, it is rational sounding, and it will ruin you if you are not careful about it. Let us think about this carefully. The seduction of the recent record. There is a particular kind of investor behavior that finance textbooks sometimes acknowledge, but never fully explain. It goes like this. A fund, a strategy, an asset class produces exceptional returns over some visible window of time, say 3 years or 5 years or a full market cycle. The returns are audited, real, documented. The manager is celebrated. The articles are written. The institutional allocators begin their due diligence. The retail investor reads a headline and the capital flows in. This is not irrational behavior. It is, in fact, deeply understandable behavior. We are pattern recognition machines. We see something work repeatedly and we extrapolate forward. The brain that helped our ancestors survive long enough to reproduce was exactly this kind of brain, one that remembered which berry bush produced fruit last season and returned to it the following year. The problem is that markets are not berry bushes. Markets are adaptive systems, populated by millions of other pattern recognition machines, all doing the same extrapolation at roughly the same time. And when everyone arrives at the same berry bush simultaneously, one of two things happens. Either the berries run out or the price of the berries rises to the point where the trip is no longer worth making. This is what I call the lag structure of hope. The performance that attracted your attention was generated by conditions that may no longer exist by the time your capital arrives. You are not buying the strategy that produced those returns. You are buying its reputation. And reputations in financial markets are priced the same way. Everything else is expensively when demand is highest, and most expensively precisely at the moment when the underlying reality is beginning to shift. First level and second level. Let me pause here and introduce a distinction I have returned to more times than I can count. It is the difference between first level thinking and second level thinking. First level thinking is fast, associative, and comfortable. It sees a pattern and acts on it. The fund returned 25% per year for the last 4 years. Therefore, put money in the fund. Second level thinking is slower. It asks the next question, and then the question after that. The fund returned 25% per year for the last 4 years. What conditions produce that result? Is that environment likely to persist? If other investors have seen the same track record, what has that done to valuations in the strategy's target market? If the manager was running $500 million 4 years ago and is now running $8 billion, does the edge that worked at small scale still function at this size? Notice that second level thinking does not require pessimism. It does not require you to conclude that everything is overpriced and nothing is worth doing. It requires only that you think one step further than the crowd, because the crowd's thinking is already in the price. What the crowd knows, the market knows. What the market knows, the market has priced. The opportunity, if one exists, lies in the gap between what the crowd perceives and what is actually true. Performance chasing is the market incarnation of first level thinking. It is intellectually seductive because it arrives dressed in data. The numbers are real. The returns happened. But the question that matters is not whether those returns occurred, The question is whether the conditions for their recurrence are present today. And 9 times out of 10, when the performance data is spectacular enough to attract large inflows, the honest answer to that question is no. The geometry of risk and return. Now, I want to be precise about something because imprecision here is expensive. There is a standard diagram taught in every finance curriculum. Risk on the x-axis, return on the y-axis. A line running from lower left to upper right, implying that accepting more risk produces higher expected return. This is, in rough outline, true, but it is incomplete in a way that matters enormously. The diagram shows expected return. It does not adequately illustrate the distribution of actual outcomes. And the distribution of actual outcomes is where the real education happens. When you move up and to the right on that diagram toward higher risk, higher expected return territory, 2 things happen simultaneously. Your median outcome improves modestly, but the variance of your outcomes increases substantially. The bad tail gets longer. The probability of a permanent loss of capital rises. You are not just accepting the possibility of a bad year. You are accepting the possibility of a catastrophic year, a year that sets you back a decade, a year from which portfolios do not recover in any humanly meaningful time frame. This is the geometry that performance chasers consistently misread. They see the high returns produced by a high-risk strategy in a benign environment and interpret them as skill or edge or durable advantage. What they may actually be observing is a strategy that is short, a very fat, very infrequent, very catastrophic tail, and has not yet had that tail called against it. Nassim Taleb has written about this extensively. I think about it differently, but arrive at the same destination. The manager who earns excellent returns for 3 years by running concentrated, leveraged, illiquid positions may be doing something genuinely skillful, or he may be picking up nickels in front of a steamroller, collecting small, frequent gains while accumulating an invisible, growing exposure to a loss that will one day arrive and erase years of work in a matter of weeks. The problem is that from the outside, during the good years, you cannot tell the difference. The track record looks identical. And this is precisely why the recent track record is such an unreliable guide to future performance. It cannot tell you what kind of return profile generated it, the cycle that feeds on itself. Let us now trace the full anatomy of the performance trap, because it is not a single error. It is a self-reinforcing loop with distinct stages, and each stage makes the next one more likely. Stage 1 is the environment. Conditions are favorable for some particular strategy, say long-duration bonds or private credit or emerging market equities. The strategy performs well because the macroeconomic tailwinds are strong. Any competent practitioner in the space earns good returns. Some earn exceptional returns. Stage 2 is the attention. The returns become visible, first to sophisticated allocators, then to a wider audience. Articles are written, rankings are published, the manager's name circulates. Capital begins to flow toward the strategy. Stage 3 is the compression. As capital floods into the strategy, the supply of attractive opportunities in that space diminishes. Yields compress, valuations rise. The very success of the strategy attracts competition, and competition erodes the edge. The manager who earned 20% annual returns with $300 million is now managing $3 billion. The deals that made sense at $300 million are too small to move the needle. The larger deals come with more competition, more efficient pricing, and thinner margins. Stage 4 is the persistence illusion. Returns moderate, they are still positive, perhaps still above a benchmark. The narrative around the strategy remains strong. Investors who arrived in stage 2 are sitting on good gains and feel validated. New investors arriving in stage 4 look at the track record and see only stage 1 and stage 2. They do not know they are in stage 4. Stage 5 is the recognition. Something changes. The macro environment shifts. A rate cycle turns. Liquidity conditions tighten. The invisible tail risk that was embedded in the portfolio since stage 1 is called the drawdown is sharp because the strategy was never as robust as its track record suggested. It was correlated to a single factor that is now reversed. Stage 6 is the exit. The investors who arrived in stages 3 and 4, the ones who paid the highest prices for the established reputation, sell into the decline. They sell at the bottom of the drawdown, locking in losses on assets they originally bought at inflated valuations. In a strategy they entered precisely because it had already performed. This is the full geometry of the performance trap. It is not simply that you buy high and sell low. It is that you buy high because everyone else is buying, hold through the deterioration because the narrative stays intact, and sell low because the narrative finally breaks. The psychology of each stage is individually understandable. But the cumulative result is that the very behavior that feels most rational at each moment produces an outcome that is deeply irrational in aggregate, what the calendar cannot tell you. Here is where I want to make what I believe is the most important point in this entire examination. Performance is not just a number. It is a ratio. It is a return divided by the risk that was taken to generate it. And the denominator of that ratio, the risk actually absorbed, is almost never visible in the standard presentation of a track record. When a manager shows you a 5-year return series, they are showing you the numerator. They are showing you what you received. They are almost never showing you a fully honest accounting of what could have been lost. The drawdown statistics are disclosed, yes. The maximum drawdown in the historical period, but maximum historical drawdown is not the same as maximum possible drawdown under plausible future conditions. It tells you the worst thing that already happened in a sample that was selected partly by chance to exclude the worst things that could happen. I have a framework for thinking about this that I call the denominator problem. When evaluating any investment result, ask yourself, what was the range of outcomes that could have occurred? Not the range of outcomes that did occur across the historical period, but the full distribution of outcomes that the strategy was exposed to, including the ones that fortune did not deliver during the measurement window. A poker player who goes all in with a pair of twos and wins is not demonstrating skill. The process was wrong, regardless of the outcome. The outcome was lucky. Investing works the same way. A strategy can be fundamentally unsound and still produce good returns for years until the improbable event that the strategy was implicitly betting against finally arrives. When you chase the returns of that strategy, you are not chasing skill. You are chasing luck and arriving after the luck has already been deployed. The defense of not doing. There is a phrase I have come back to often across 50 years of investing, and it captures something I genuinely believe. If we avoid the losers, the winners will take care of themselves. This is not an argument against seeking return. It is an argument about sequencing and emphasis. The financial industry is structured to sell you offense. It leads with the upside case. The pitch is always about what you will gain. The conversation about what you might lose, the honest, unvarnished conversation about the full range of outcomes under adverse conditions is structurally underemphasized in almost every sales conversation I have ever witnessed. The reason is not necessarily bad faith. It is incentive. The manager earns fees on assets under management. Assets under management grow when investors allocate capital. Investors allocate capital when the upside case is compelling. The incentive structure therefore rewards clarity about upside and encourages vagueness about downside. This is not a conspiracy. It is just gravity. Systems behave in the direction of their incentives, which means the investor must compensate. If the presentation is structurally biased toward optimism, the investor's due diligence must be structurally biased toward skepticism. Not cynicism, skepticism. Not the refusal to believe anything, but the discipline to ask the questions that are not volunteered. What happens in the bad scenario? How bad is bad? Has the strategy been stress tested against conditions it has not yet encountered? What is the liquidity profile in a redemption scenario? What assumptions about the macro environment are embedded in the model, and what happens when those assumptions fail? These questions are uncomfortable. They slow down conversations. They are not popular at pitch meetings, but they are the only honest questions, and investors who skip them in the excitement of chasing a strong recent record will pay for that skipping eventually in the currency of capital loss. The temperature of the room. I want to offer you a practical framework for calibrating your own exposure to the performance trap. I call it reading the temperature of the room. Markets, at any given moment, have a temperature. They run hot or cold. Hot markets are characterized by abundant liquidity, compressed risk premiums, high valuations, aggressive lending standards, universal optimism, and the widespread belief that risk has been permanently tamed or redistributed to someone else. Cold markets are characterized by illiquidity, wide spreads, cheap valuations, reluctant capital, universal pessimism, and the widespread belief that everything is permanently broken. The critical insight is this: the temperature of the market is inversely correlated with the prospective return available in that market. Hot markets feel safe because everything's been going up, but they are the most dangerous environments for deploying capital. Cold markets feel dangerous because everything has been going down, but they are the most attractive environments for deploying capital. Performance chasing is almost always a hot market behavior. You chase performance when things have been going well, when the track record is long and impressive, when the consensus endorses the strategy, and you are chasing it precisely when the market's temperature is highest, when valuations are richest, when the margin of safety is thinnest, when the distance between current prices and underlying value is widest. This is not a coincidence. It is structural. The performance that attracted your attention was generated in a hot environment. The hot environment pushed up prices. Pushed up prices inflate reported returns for anyone who was already positioned. Those inflated returns attract attention. The attention brings more capital. More capital pushes prices even higher, inflating returns further, attracting even more attention. The cycle feeds on itself until it cannot. So the temperature check is simple in principle, though difficult in practice, because it requires going against the emotional current of the room. When everything feels good and everyone is performing well and the headlines are uniformly positive, ask yourself, is the current temperature appropriate for aggressive capital deployment? Or is this the moment for patience, selectivity, and caution? And when everything feels terrible and the headlines are uniformly dire and the consensus is that things will not improve, ask the same question in reverse. The asymmetry that matters. Let me now consolidate everything into a single framework that I believe is the most useful lens for thinking about performance and risk. The key insight in all of this is that investment outcomes are asymmetric in a way that conventional return analysis systematically understates. A 50% loss requires a 100% gain to recover. A 33% loss requires a 50% gain to recover. Losses, in other words, compound in the negative direction with an efficiency that gains cannot match in the positive direction. This is not a paradox. It is arithmetic. But it is arithmetic that almost no one internalizes at the gut level. What it means practically is that the avoidance of large losses is more valuable per unit of impact than the achievement of large gains. The investor who earns 12% consistently year after year without catastrophic drawdowns will, over a long enough horizon, produce a better outcome than the investor who earns 25% in good years but loses 40% in bad ones. The consistency of positive compounding is more powerful than the amplitude of any single year's return. I call this the asymmetry premium, the value created not by seeking high return, but by avoiding high loss. It is invisible in short-term analysis. It reveals itself only across full market cycles and long time horizons, which is exactly why it is consistently underpriced by a market that is structurally focused on the next quarter's performance, the next year's ranking, and the most recent track record. The performance chaser, almost by definition, ignores the asymmetry premium. He is selecting for historical upside and implicitly accepting whatever downside is embedded in the strategy. He is buying the numerator of the return to risk ratio without properly pricing the denominator. And in doing so, he is taking on risk that is greater than he understands at a price that is higher than it should be at a moment in the cycle when caution would serve him better than aggression. The closing position, we have covered a great deal of ground today, and I want to pull the threads together before we close. The performance trap is not a failure of intelligence. It is a failure of framing. Investors who fall into it are not foolish. They are responding rationally to incomplete information in an environment that is structurally biased toward presenting upside and obscuring risk. At a moment in the market cycle, when the emotional current is flowing strongly in one direction, the antidote is not pessimism. The antidote is the second level discipline of asking the next question. Not just, did this strategy work, but under what conditions did it work, and do those conditions currently exist? Not just what did I earn, but what did I risk to earn it, and was that risk appropriate? Not just where is the market going, but where does the market currently stand? And what does that position imply about prospective returns? These are harder questions. They produce less comfortable answers. They sometimes lead to the conclusion that the most rational action is no action, that patience is the position and waiting is the strategy. And in a world that rewards activity, celebrates decisiveness, and measures you against benchmarks every quarter, the discipline to do nothing when doing something is likely to hurt you is one of the rarest and most valuable things an investor can possess. I have one concrete request for you today. Before your next capital allocation decision, before you move money toward a strategy, a fund, a manager, a sector, ask yourself honestly, am I doing this because I have identified a durable edge at a reasonable price? Or am I doing this because it has already worked and I am afraid of missing more? The first reason is investing. The second reason is performance chasing. And the distance between those two motivations is the distance between building wealth and destroying it. The pendulum does not stop in the middle. It never has. Every cycle in my career has eventually corrected, regardless of how compelling the narrative that sustained it appeared while it was running. The correction always came. The question is always the same. Did you deploy capital when conditions were favorable, or did you deploy it when the record was favorable? Because those two moments are almost never the same moment. They are separated by exactly the lag that the performance trap exploits. Know where you stand, ask the harder question, guard the denominator, and let the winners, the patient, the skeptical, the second level thinkers, make themselves known over time. That's all. Thanks for watching.